With nearly 6 decades of investment banking experience in the Philippines, First Metro Investment Corporation knows exactly how to navigate unexpected events, including the COVID-19 pandemic of the past couple of years. As the investment banking arm of Metrobank and as a prime mover in the development of the Philippine capital markets, First Metro uses its in-depth understanding of markets to find smart solutions for its clients. That is why it won the Asia Money Award for Best Securities House in the Philippines in 2022. Much of the hard work behind the scenes is spearheaded by 3 people. Jose Patricio Dumlao, who is First Metro's president, working with Daniel Camacho, Executive Vice President and Head of Investment Banking, and Peter Anthony Bautista, First Vice President and Head of Sales and Distribution. Together, they ensure that First Metro offers a complete suite of services to its clients. This spans everything from debt and equity underwriting and financial advisory to government and corporate securities brokering, equity brokering, and asset management. First Metro's underwriting strength is complemented by its ability to distribute widely, not only to its corporate and institutional clients, but also to its retail clients. When it comes to its retail reach, First Metro leverages the strength of the branch network of Metrobank and the growing clientele of its online brokering arm, First Metro Securities. This means that across primary ECM and DCM, First Metro worked on some marquee deals in the past year, giving it a market share of 87% of all capital markets transactions in 2021. But that wasn't all. The firm also ensured its clients and the investing public were informed about key market developments amid the pandemic. It did these through investment literacy webinars and market briefings, both of which got a solid response from clients. First Metro is not staying still. It is always keeping an eye on finding new business opportunities and enhancing its existing capabilities across products. All these factors ensure that First Metro remains a front runner in the Philippine investment banking industry.
When was the last time you did something for the first time? You remember that feeling of hesitation. Maybe you're not ready. Perhaps you're not good enough. You doubt yourself. It's a long road ahead. And right now you think, safe is a good place to be. You take a step back, but in doing so, you see the whole picture. You remember the stakes you were brave enough to take. So you shout at the unknown no longer, because you are your own master. You rise up because you know you're not alone. Because you stand on the shoulders of the ones before you. And through them you realize you are more afraid of not trying than failing. They hold your hand, lead you to the peak of your potential. And once on top, you take the leap and do it. The first time you flew and tasted freedom. The first time you went the extra mile and never looked back. The first time you understood that something so small could change the course of your future. The first time you put yourself first. At First Metro Asset, we value you and your achievements. As we navigate through this better normal together, we are here to help you cherish your firsts and make those moments last.
Trading on the go? Here's First MetroSec Go for you. Easily open your account today with this app. You can download the First MetroSec Go app through Play Store or App Store for free. If you already have it on your device, simply open the app and click Sign Up Now. Next, you need to create a user ID, read and agree to the terms, and provide these information. Once you're done, click the link on the email verification sent. Now, let's complete your account application. First, input your account information. Then, provide your user information. Next, accomplish the investor profile form. Almost there! Read and agree to the terms and conditions. Then click Agree. You will then receive your reference number through the app. Don't forget to save this number because you will need it for your initial deposit. Next, upload or take a photo of these requirements. 1 valid ID, 3 signatures on a piece of white paper, proof of address, and proof of bank account. If you're self-employed, there are additional requirements. Now let's fund your account. You can make your initial deposit through bills payment, online fund transfer, over-the-counter deposit, or remittance. The minimum 5,000 pesos or $100 can be used to invest in stocks, funds, and bonds. There is no maintaining balance required. Next, you will need to verify your identity. Simply take a photo of your ID and take a selfie. You're all set. An email confirmation will be sent to you in 2 to 3 business days. Happy trading! For more information, visit our help center at help.firstmetrosec.com.ph. All the options and convenience within your reach through International Finance's best online broker and best online trading platform for 4 years in a row. With First MetroSec, it's your future first.
With nearly 6 decades of investment banking experience in the Philippines, First Metro Investment Corporation knows exactly how to navigate unexpected events, including the COVID-19 pandemic of the past couple of years. As the investment banking arm of Metro Bank and as a prime mover in the development of the Philippine capital markets, First Metro uses its in-depth understanding of markets to find smart solutions for its clients. That is why it won the Asia Money Award for Best Securities House in the Philippines in 2022. Much of the hard work behind the scenes is spearheaded by 3 people. Jose Patricio Dumlao, who is First Metro's president, working with Daniel Camacho, Executive Vice President and Head of Investment Banking, and Peter Anthony Bautista, First Vice President and Head of Sales and Distribution. Together, they ensure that First Metro offers a complete suite of services to its clients. This spans everything from debt and equity underwriting and financial advisory to government and corporate securities brokering, equity brokering, and asset management. First Metro's underwriting strength is complemented by its ability to distribute widely, not only to its corporate and institutional clients, but also to its retail clients. When it comes to its retail reach, First Metro leverages the strength of the branch network of Metro Bank and the growing clientele of its online brokering arm, First Metro Securities. This means that across primary ECM and DCM, First Metro worked on some marquee deals in the past year, giving it a market share of 87% of all capital markets transactions in 2021. But that wasn't all. The firm also ensured its clients and the investing public were informed about key market developments amid the pandemic. It did these through investment literacy webinars and market briefings, both of which got a solid response from clients. First Metro is not staying still. It is always keeping an eye on finding new business opportunities and enhancing its existing capabilities across products. All these factors ensure that First Metro remains a front runner in the Philippine investment banking industry.
Good afternoon and welcome to First Metro's Midyear Economic and Capital Markets Briefing. Let's begin this afternoon's program with a prayer to be led by Mr. Gonzalo Ordonez, President of First Metro Securities Brokerage Corporation. The prayer will be followed by the Philippine National Anthem.
In the name of the Father, and of the Son, and of the Holy Spirit. Amen. Dear God, thank you once again for this little miracle that we have come to take for granted. Our ability to break physical distances and come together online today for this First Metro Mid-Year Economic Briefing. Thank you for all our blessings, including the relative freedoms we have after months of lockdowns, and for the relative peace in our neighborhood, our homes, and our hearts, despite the chaos in the world. We thank you for giving us this opportunity to listen, to plan, and to strategize, to look beyond the next meal, the next nightfall, the next breath, and to plan for the future with confidence and with hope. We are now more aware, Lord, of our blessings and of our dependence on your will. Bless us, Lord. Bless our country. Bless the world. We are all in need of an outsized share of your miracles. Please guide our speakers with insight, wisdom, and eloquence. Quiet our hearts, Lord, so we can take pause and integrate new ideas into our financial plans. Touch us, Lord, as we exit this briefing, to consider, decide, and to do what is best for our stakeholders and our own finances, and to touch the lives of the marginalized. Inspire us, Lord, to change the world, starting with the world of one person. Amen. In the name of the Father, and of the Son, and of the Holy Spirit. Amen.
Ladies and gentlemen, our host for this afternoon's briefing, Ms. Karen Liza Roa, President of First Metro Asset Management Incorporated.
Good afternoon, everyone. Thank you for joining us today. This is the First Metro Group's 12th year in providing you with biannual macroeconomic outlooks, perspectives on the capital market, as well as our favorite stock picks and their respective drivers. That video was quite somber, and our title for this afternoon's forum is Recharging the Philippine Economy. We will hear from the experts and our field soldiers whether in fact we are ready to be recharged, if we have what it takes to be recharged, and hopefully how to get the economy springing in the midst of all of these local and global events. In the last 2 years, we have invited distinguished guests to share with us their thoughts and their convictions regarding global trends, strategies, and the like. This afternoon, we will also have an international guest speaker who will provide his views on possible global investment strategies. To start our program this afternoon, and joining us for the very first time as the new Chairwoman of First Metro Investment Corporation, and who is also Metrobank's Executive Vice President and Head of Institutional Banking Sector, let us all welcome Ms. Mylene Caparas to give the opening remarks.
Good afternoon, ladies and gentlemen. It is my pleasure to welcome all of you for the first time, for my very first time, to the First Metro Group's Midyear Economic and Capital Markets briefing. In our briefing in January this year, we did say that the Philippines is back on track, and that was indeed our outlook on the overall state of the economy at that time. However, as we all know, in just a period of 6 months, so many things have changed. The good news is that the Philippine economy expanded by 8.3% in the first quarter, higher than expectations. And we are expected to continue to outpace our neighbors in terms of growth. But there are serious challenges to achieving robust and sustainable growth, challenges that were not present and not critical threats a mere 6 months ago. In the global arena, growth is projected to slow down, largely due to the Russian invasion of Ukraine, which has adverse economic and humanitarian consequences. And for a world that is still on the mend from the onslaught of the pandemic, we are confronted yet again with tensions that could drag recovery. Similar to other countries, we here in the Philippines are faced with surging inflation, a weakening local currency, and a sizable budget deficit as a result of the COVID-19 crisis. Despite all these issues facing us today, you will hear through our speakers that the country's macroeconomic fundamentals do remain sound, and that we do have a better economic situation now than in the past crisis. At the end of the day, our economy is still growing and will continue to grow, albeit slower than earlier projections on account of the many changes and challenges that we are faced with. But if we're able to overcome them and address these concerns accordingly, they will only serve to further strengthen the economy and lead us all to sustainable growth. Friends and guests, sit back, relax, and listen to our speakers as they give a clear picture of the current economic and investment landscape, as well as share their outlook for the remainder of the year. Again, welcome to all of you, and thank you for joining us today.
Thank you very much, Ms. Caparas. At least we've been set on the right foot. Good, nice tone, very positive and very optimistic. For this year's forum, we're changing the format a little bit. After each speaker, we will allow for a few questions in case there are burning questions that you just need to get off your chest right away. Okay, so let's listen intently and let's write down our questions. You can send it by the chat box. Then after all the presentations, again, a panel discussion will take place. Before we move on to our next speaker, as we've done in the past, let's all have a few poll questions because it's always good to get everyone's attention and participation. I will ask a question, provide some multiple choice answers, and you'll see it in your screen. A pop-up screen will appear in front of you where you can click your answer. We will quickly tabulate the answers and provide the consensus at the end of the next speaker. Okay, everybody with me? So for poll question number 1, the question is, what do you think is First Metro's GDP forecast for the year? Is it 5 to 6%, 6 to 7%, 6.5 to 7.5%, or 7 to 8%? I think more than wanting to find out what you think, I think it's wanting to find out your perception of us, whether we really think our projections are irrational or sensible. Okay, everybody have that? Thank you. Let us now call on our first speaker, the specialist in macroeconomics, a veteran in all of our forums, senior economist for University of Asia and the Pacific, Professor Victor Abola. Dr. Abola?
Good afternoon, friends. Here I am again. So let's go over the presentation today. As usual, we review our performance recently, and the important thing to look at the global economic outlook as well as the domestic environment. And there's a specific feature that we are including today, which is the comparison of the situation now versus past crisis. Then we look also at some key issues and then end with our macroeconomic forecasts. So first of all, we see that we grew by, as was mentioned, 8.3% GDP. But look at the other numbers covering the red bars, which is domestic demand growth, way above those of the GDP. Even in the past, you can see it because domestic demand is comprised of household consumption, government spending, and investment spending. So our growth has been domestic demand driven, and that continues today. So, okay, part of that narrative is that consumer spending has recovered to its levels in the first quarter of 2022 to first quarter of 2019. With the fast growth that we saw for consumer spending at 10.3%. Investment spending in the first quarter of 2022 remained double digit at 20% growth, but it's still some 9% below the 2019 first quarter. And so we now move into the global economic outlook, where the game changer has been the invasion of Russia of Ukraine, which has been the source of the global slowdown and inflation. The IMF has cut its world growth projection by 1.3%. The US and the EU growth has been cut by 1.5%, and China's growth by minus 1.2%. How long will the global inflation last? Well, it really depends on the war and how fast alternative sources of energy get into the markets. So here we have a projection of the trend based on 2017 to 2019 in the dotted line. And you can see that even by 2023 next year, with the growth, we're still below that trend lines. So looking at it from the specific countries or country groupings, we have there the 2021 growth recovery, fastest in, well, China and the US. And for 2022, the outlook had been cut, as I mentioned earlier, is for the world, for the US, for Japan, fairly stable, and for China, less than 5%. And for the ASEAN 5, minus 3%. Okay, so for 2023 next year, it's still a growth story, continues, but it's focused on China and ASEAN, where you can see the upgrading of the acceleration from 4.4 to 5.1 in China, and for ASEAN from 5.3 to 5.9. Okay, so that said, I think that's clear. The general outlook is clear. But let's take a look at the Philippine situation. Okay. The issues I'll cover will be how long will inflation last? Are we better off than previous crisis? Will BBM administration be positive for growth recovery? And then are we heading for a credit upgrade? So for the first part with the inflation, the BSP has revised twice its forecast by 2.5% this year and 4.2 next year. And the reduction in 2023 is more or less in line with IMF's overall reduction. But they make caveat on the upside. The war is prolonged, which means more elevated oil and commodity prices, supply constraints that also are partly caused by that, and then more internal to each major economy is that the labor shortage. They find a mismatch of skills and the new economy's requirements. Okay, taking a look at the crude oil prices, which is the immediately impacted by the war, and we see how the Department of Energy of the United States has raised its forecast, particularly for next year. The average is more than 9% higher than their previous forecast. And for 2022, the average is more than 2% higher. But in our case, of course, we take a look at the forecast, which ours happen to coincide with the of the BSP at 5% for this year. For next year, it's more along 4%. So, but the Philippine inflation rate is being driven primarily by food and crude oil prices. And the good thing about food prices is that it's not about rice. It's been about vegetables, meat, and fish, which are solvable domestically. The crude oil prices may probably have seen their peak. If we look at the graphs, something like that is suggested. Now we take a look at the present situation compared to the past crisis in terms of one, the growth rates of the real sector, real GDP growth in better than 1980s. We're not as good as the Asian crisis and world financial crisis. Consumption spending certainly better than the previous crisis. Investments more or less, well, it's still better in 1980s, but better also than the two previous crises. And then in terms of exports, we're still much positive, better than the world financial crisis and the crisis of the 80s. So it's moderately better now in this regard. We look at the agriculture and industry first in this table. And we can observe that agriculture has performed better in this crisis. But industry is somehow lagged a little bit, but better still than the 1980s. Where we stand out clearly better will be in interest rates, which T-bill rates are very much lower than they were before, and inflation rates as well. So then now we move to the debt exchange rate issues, where we can see that although the peso has been depreciating in the last 3 years, the increase has been much less than compared to the increases in the past years, in the past crisis. Our international reserves in terms of months of imports have also been better than previous crisis, and our external debt is way much better than it was during the first crisis of the 80s and the Asian and world financial crisis. Now, also very important in this regard is the percent of interest expense to total national government spending, which we can see is half of what it was in those two crises. Clearly, in this regard, we are better than it was in the past. So we move on now to looking at it a little closer. The debt ratio, of course, was lowest in 2019, but it rose to 60.5% in 2021, which, however, was the level midway in the GMA administration, and it kept going down. Why? Because there was fast growth. There's also low interest rates. By the way, even if interest rates are rising, they're still low compared to then. In 2018, for example, 10-year bond yields for almost 9 months stayed at around 8%. We're not quite close to that. And so I forecast that we'll reach a debt ratio of 65 to 66% in 2022 and remain below 70% in 2023. But what is more important is really the interest expense as a percentage of national government expenditures, which is still quite low. You have to remember that the important thing here is the difference between the the 31%, the height, and then the 10% now, which is creates you a 20% spread that was enabled us to have that construction and infrastructure boom. Okay, so we look at BBM and the prospects of Philippine growth with you. And first look at the cabinet appointments. We have the BSP, DOF, DTI, Fred Pascual, DPWH, Mark Banoan, DOTR, and now very recently DOE. These are really experts and people who are very good at their jobs. I would say I put an excellent rating for the choices. And one of the things that they will focus on will be try to lower the budget deficits. Not that it's sort of overarching goal, because the overarching goal is still to reduce poverty rates, but it will provide us leeway to grow faster in the future. Now, there's special focus that the president has taken by getting hold of the agriculture portfolio, initially at least, which shows his importance and priority that he will give to it. Because that actually is the lagging sector and the source of the poverty in the country. Most of the poverty is there in the agriculture sector. So let's take a look at power and infrastructure. Because of the financial constraints and also a bit of overemphasis in ODAs in the previous administration, we will likely see more PPPs in this administration, because that means the president will be committed to a double-barreled approach to infrastructure. It's not only the government, but government plus private sector. However, for the private sector to get into things, the BOT IRR, implementing regulations and the law needs updating. The IRR was revised just before, that's May this year, and is not very friendly to investors. And also the law itself is ready for updating, just did not catch the end of Congress. Congressman Salceda is again willing to take the cudgels for this, and we expect it to be revised fairly soon. Now, agriculture, the focus will be on irrigation, cold and dry storage, and then high value crops without disregarding the key crops of the country. So in short, look, for me, looks positive. And we now focus on the last issue of credit upgrade, where these metrics may be more important. Okay, gross international reserves. If we look at it, we were above our neighbors, our peers, and we see that Malaysia was much, it's about half of us, and then Vietnam, one of the darlings of the region, very low, 3.9, and Indonesia at 8 months. So we're okay there. This may be something that people may be worrying about, the exchange rate. But if you can look at this graph together with the US dollar weighted exchange rate, it's just tracking US dollar strength. However, there's the added pressure provided by the trade deficits, which has been rising fast due to the oil prices. Last year we had a record high of 43 billion in trade deficit, and I expect it to reach 50 billion this year. Precisely the exchange rate is the mechanism by which the economy adjusts to that. And the idea that it's going to hurt the country, the exchange rate is not, it's not well founded. Because yeah, for one, we have OFW remittances, which contribute to the income of the country. And you see the growth of the peso in peso terms, the OFW in peso terms, they're in the red line. And then we have the, and that's growing closer to 10% due to the depreciation. In the case of BPO, which is catching up with our OFW remittances, it was 28 billion in 2021, and it's growing to go at least by 6% this year. In segments that were sort of unheard of before. As a matter of fact, the voice call centers have become less than 50% of BPO earnings. So these two can offset actually the deficit, but to a certain extent. And with that, the external sector becomes still strong compared to ASEAN, where you have Malaysia, IA minus with such a high debt ratio. And we said we have a steady source of FWs and BPOs. And with the emerging segments being catered to by RBPO. So I see a low probability of any downgrade in 2022 and 2023. Now, this is another aspect of the growth story, which is the new jobs created. You can see in this graph that, and it does not include that the May, because it just came out, May is positive 600 plus jobs. So overall, you can see there are 4 major downs, much bigger growth. And so that's why employment reached a record high of 47 million in March 2022. And that has overflowed into improving consumer confidence as reported by the BSP survey. As you can see, everything here, whether it be for the current quarter, the next quarter, the next 12 months, they're all moving up. Okay, with that, I'll present now my forecast for the economy. Inflation rate at 5%, peso dollar rate should go back between 54, 55 because by towards the end of the year, last quarter, you have a big inflow of OFW remittances. International sales would be around 104, and then the GDP growth of 6 to 7%, led by the industry sector, which is manufacturing and construction, which also have been the ones providing for job growth in the industry sector. In summary, so we do expect faster GDP growth this year, next year. Inflation will be above target in 2022, not the doing of the BSP, but due to external reasons. We are in a better economic situation compared to past crises. BBM will generally be positive for growth, both not only in terms of people, but also the policies that are being prioritized. And I don't see any credit downgrades. So what are the caveats? The downside of my forecast would be if inflation goes faster and remains high. That's not my view, though. I mean, prolonged Russia-Ukraine war, which prevents the commodity markets, especially crude oil, from getting into the market and putting pressure downwards. You have also prone to natural disasters. Fourthly, we might overreact to supposed pandemics of lockdowns, which, however, I don't think the president is very much in favor of. And finally, what about Fed policy rate hikes? I think that they won't pull up local interest rates that much because US inflation is simply much higher than the Philippine inflation by at least 250 basis points. So I'm quite fairly optimistic that we can recover quite fast. Maybe not as fast as originally planned, but we'll get there. Thank you, and we'll try to answer your questions later on.
Thank you very much, Dr. Abola. Don't disappear just yet because we will have some questions. But I thought that was
Okay.
quite comforting for the audience. I hope they think that's the same way. Again, if I may just summarize what you had just said, faster GDP is expected in 2022 and 2023. There is no expectation of any credit downgrade in 2022 or 2023 as well. Stronger economic situation than previous crisis, despite the headwinds that remain, which is high inflation, the Russia-Ukraine war, and the natural disasters. Okay, so I think that no matter what, we are well poised to weather this storm. Let's see if there are any questions to Dr. Abola regarding his presentation. Doc, are you there? Okay, you are there. All right, I have a question here from the floor. That first, how will the looming US recession play out for emerging markets, especially the Philippines, where the US is our biggest source of remittances and BPO business, as well as one of our biggest export markets?
Um, I think the recession will have an effect, but not that much compared to other countries because our exports are a smaller, much smaller percentage of GDP. Secondly, exports to the US are only 15% of our total exports. Well, the only reason why remittances come from the US is because they are coursed through US banks. Not that it's really the majority. There's a big question there, a lot of uncertainty because, for instance, in Saudi Arabia alone houses 2 million Filipinos. So, in the Middle East, altogether will outnumber those in the United States. So yes, there will be an effect, but since I mentioned earlier, I emphasize that our growth is demand-driven, domestic demand-driven. It will be our construction, our infrastructure, and investment spending that will take us to the growth path that we are headed for.
Okay, thank you for that, Dr. Bola. There's another question, and you touched up on BBM's, perception for growth, right? So the question is, how do you view the new set of economic managers under the new administration? Do you have any expectation how the new administration's economic policies will shape up?
Well, you can see that these people that he has appointed are not new in the sense, new to the game, meaning to the economic situation. They Diokno, Ben Diokno, Philip, and Popo Lotilia, they're just been there and they have the expertise. And I think they're quite independent, and they've, I mean, these have very strong personalities, and can, there is a question that puts it where can they withstand pressure from BBM? As a matter of fact, I think BBM is pragmatic enough to realize that he has to rely on the economic team if he's going to deliver on the growth that he has promised to us.
Okay, all right, that's true. That's very true. Okay, and maybe one more. Amidst fears of global economic slowdown, outlook for the Philippine economy remains robust, as you had presented. While you have outlined both the upside and the downside risks to growth, what would you consider to be a major risk that we need to closely monitor so that we are able to sustain the growth and your projected numbers?
I think it still is Russia-Ukraine war. It gets prolonged beyond this year or beyond the fourth quarter of this year. We might run into rougher waters. But because that is linked to crude oil prices, commodity prices, wheat prices have gone up by 30%. And so pandesal is shrinking. That's why for me, that is a major factor. But it can also be resolved earlier, in which case the growth story will be realized sooner.
Thanks, Dr. Bola. And one more last. There's a lot of questions. So what we'll try to do is we will try to consolidate them also. And then if we don't have time after each speaker, then we will try to tackle them during the panel discussion. But I thought that this question was quite interesting. So if you may, in your models, how sensitive is inflation rate to FX movements? To be clear, for every 1 peso depreciation in the peso, how much does it affect inflation?
Actually, it's our model is not the peso but percentage. The pass-through is very small actually. Contrary to a popular conception, it's only about for every 10% increase in the exchange rate, you add 0.6% to the inflation rate. I mean, that's small, no? Right? Relative to other factors.
Okay, thank you, Dr. Bola. That
And the
was
BSP people also have come up with similar conclusions. I mean, their own studies.
okay. All right. Like I said, no, we'll consolidate more for the panel discussion later on. But thank you for that presentation, Dr. Bola. Okay. As promised, I would like to go back to the answer to the poll question number 1, wherein we had the question was, what do you think is First Metro's GDP growth projection for year-end 2022? And the answer is being flashed right in front of you. 43% of you said that it's about 6 to 7%. 24% said 5 to 6%. 25% said about 6.5 to 7.5, and very few, or 8%, said that it would be 7 to 8%. And as Dr. Abola had mentioned, our projections or aspirations is that it will be 6 to 7%. So 43% of our pollsters are actually aligned with our presenter. Thank you very much. Okay. All right, let's go on. Our next speaker will review the state of our capital market, both debt and equity, and provide an outlook for 2022 or the remainder of 2022. Mr. Daniel Camacho is an executive vice president and head of First Metro Investment Corp's investment banking group. Go ahead, Dan.
Thanks, Karen. So welcome to everyone. Thank you for joining us this afternoon for our economic briefing. Hold on. Sorry, just having difficulties.
You okay, Dan?
Yeah, just can't quite find it. Is that sharing now, Karen?
Yep.
Okay.
I see it.
Thank
Okay,
you.
go ahead.
Thanks. So let's take a quick look at the capital markets this last 6 months, starting off with the debt capital markets. In the local bond market, we can look forward to another record year. Liquidity continues to be high, with investors looking for a home for their investable funds. Corporate bonds for the first half of this year have already exceeded full year of 2021. In fact, in our recent issuances, the base size was oversubscribed by 3 times, 4 times, or even more. So to all our investors out there, continue to expect your allocations to be a fraction of your orders. We expect, though, corporate bond volume to slow down in the second half, but will easily exceed for the full year the 200 billion mark. Bank bonds as well for the first half have exceeded the full year 2021. And the national government remains as the largest issuer with its 458 billion RTB issuance in March. If past years are any indication, we can expect another issuance in the, let's say, fourth quarter of the year. Frequent issuers tapped the market, led by Ayala Land, with a total debt raise of 45 billion in the first half, which I believe is a record. But we also welcome new names to the market, such as Converge, with a 10 billion peso maiden issue. All these issuances, in spite of a rising interest rate environment. You can clearly see here the upward trajectory of rates as the BSP aims to address inflation concerns, with a total of 50 basis points hike thus far, 25 bips each in June and July. We have seen a sharp jump in BVAL rates by 150 to 200 basis points since the beginning of the year. And that was after rising 200 basis points last year. Thus, the 5-year and the 7-year BVAL are double where they were at the start of 2021. Amidst persistently high inflation, the rise in rates are driven by investors' demand for higher returns, as well as the government's borrowing needs. For the rest of the year, we anticipate a further upward shift of the curve, with the widest movement on the short end by 100 to 150 basis points, catching up with a huge increase on the belly to the long end of the curve that has occurred in the last 6 months. We also forecast a 100 basis points or so increase in the 10-year rates by year end, resulting in a relatively flattening of the curve. In the US, this high or higher interest rate environment is quite significant. It has been well covered and widely discussed. But less talked about are our neighbors in the region. In Singapore, for example, the increase in rates cannot keep up with inflation that rose 5.6% in May, the fastest pace in 13 years. The government has adopted a $1 billion aid package, that's $1 billion US dollars, for citizens in the lowest income bracket. However, there are concerns that an imminent increase in GST may put that in peril. In Thailand, investors are experiencing negative real returns, with interest rates lower than the 7.6% inflation rate in June, the highest among ASEAN 5. Similar to the Philippines, the prices in Thailand at the pump have surged, with the cost of diesel spiking over 20%. The government has been forced to offer subsidies even as public debt is now at 62% of GDP. At present, the country is attempting to rely on a tourism revival to meet much needed funds. In Indonesia, while benefiting from higher commodity prices, the country hasn't been spared from having to contend with inflation that hit 4.35%, the fastest pace in 5 years. Officials have adopted various measures, such as providing energy subsidies and a temporary ban on palm oil exports. Meanwhile, in Malaysia, interest rates have jumped as well as consumer prices rose 2.8% in May. The government there is not only concerned about the cost, but the supply of food, recently banning exports of chicken. That has proved to be a headache for neighboring Singapore, who depends on Malaysia for 1/3 of its meat requirements. Malaysia also has resorted to cash handouts and declared what they call a jihad against inflation, seeking to bring down prices of basic household goods, such as cooking oil. Moving on to the equity markets, after the Omicron surge, positive sentiment drove the market higher in anticipation of a full reopening. However, this was derailed by Russia's invasion of Ukraine and the aggressive US Fed rate hikes. The index ended the first half at 6155, and while it has somewhat recovered to the 6,300 level recently, profit taking has kept the index from trading much higher. However, we look forward to robust corporate earnings this year that should fuel valuations. 2021 was a banner year for the equity markets, and that will be hard to beat. Nevertheless, there continues to be a healthy pipeline of equity deals, despite the unpredictable market we're in. The first half was dominated by Union Bank's 40 billion SRO, funds needed to acquire Citibank's local consumer business. On the IPO front, there was a slew of modestly sized issuances, the most recent of which was Balay ni Frutas, which was solely underwritten and arranged by FMIC. The dominance of local investors continue, a trend established since 2020, and the lower turnover this first half compared to last year was not surprising given the risks and volatility in the market. We are not alone in emerging markets with a lower than expected performance. Our peers, other than Indonesia, are all in negative territory in the past 6 months. But at these levels, it looks like there are bargains to be had. More on that from our next speaker, our own in-house investing guru. So for the rest of the year, clearly interest rates will remain elevated given the inflation rate and government's borrowing needs. While the yield curve has shifted upwards and steepened in the first half, we have seen a slowing of that, especially in the longer end of the curve. Now, it's too early to say whether it's peaking, considering further rate hikes by the BSP, but we do see a slight flattening of the curve. In the equity markets, while investors should be looking at fundamentals, we are all best advised to be aware of the market volatility and sentiment that can turn from positive to negative and vice versa very quickly. Before we go, we are proud to share a few of the deals we have led arranged in the first half, a combination of bonds, an IPO, and a sell-side advisory. We are proud as well to have been given accolades including the Best Securities House by Asia Money, the Verata Award by PDS in the Investment House category, and Best Fixed Income House by FMAP. We thank these organizations for the awards and the recognition of our work. So to all of you here today, we appreciate your time and for listening to our views, and now open to a few questions. Thank you.
Thank you very much, Dan, for that presentation. Are there any questions for Mr. Camacho? Okay, something's coming in right now. Okay, hold on. For Dan, how does the current economic environment change the capital raising landscape? And a follow-up to that would be, what is your outlook for capital raising, especially for corporates, for the next 6 to 12 months?
Good question. Thanks for that. Second half, I think I mentioned it briefly. Definitely, we are seeing a possible slowdown in capital raising. On the debt markets, there was a record level of issuances in the first half, and with a rising interest rate environment, we believe that there could be a slight slowdown in debt raised for the second half. In the equity markets, we can't compare to last year, even though we have a healthy pipeline. We can't avoid and dispute the volatility. So we do have ourselves mandated for a couple of IPOs the second half. If it's priced correctly, we still believe that will continue, but who knows?
Okay. There's another interesting question that this popped up in my screen also, and it says, how can REITs attract more investors? I remember you talked about REITs in the last forum.
Yes. We still believe REITs are a good investment avenue for investors because of the dividends that it pays out, especially in a volatile market. No, we must remember that REITs are still equity. Principal it's not protected. Value can still go up and down, but you do have that dividend yield that cushions that movement. So it's still a very good alternative for investors. We're still talking to issuers to see who are good REIT candidates. With rates coming up, it does become a little costly for dividends to compensate investors. So that's a trade-off that issuers will have to take into account.
Okay. Here's another question, Dan. I don't actually know how you would answer this, or but I'll shoot it out anyway.
For me,
is your break-even rate expectation, open parentheses, interest rate plus inflation rate for the second half and for 2023? Does that make sense?
yes, but maybe I'm not the best person to
Okay,
that.
we'll reserve that question for later, but I just thought it just popped out and I said, interesting question. Okay. What is your prediction for the improvement on investments for equities and balanced fund? Is that something, or should we hold off on that as well and then let our next speaker talk about that, right?
Our next speaker is the expert, yes.
Okay, let's do that. Thank you very much, Dan, and we'll
Thank you.
call on you later on for the panel discussion. Meanwhile, let us start off. Let's have another poll question. Again, a bit of a validation of your perception of our forecasts. And the question is, what do you think is First Metro Investment Corp's forecast on the PSEI by year end? Thankfully, this is a multiple choice question and not an essay one. And again, it's being flashed on your screens. 6871, 75, or 78. Okay, that's an interesting question, and it's a good segue to our next speaker. This next speaker will share with you her crystal ball and tell you what names to look out for in 2022 and her reasons for that. In this volatile time, we all could use some sound advice and a disciplined investment approach. Ladies and gentlemen, she needs no introduction. Please welcome our Head of Research, First Vice President, Ms. Christina Ulang. Christy?
Hello. Good afternoon, ladies and gentlemen, our beloved clients, followers, and believers. Thank you for being a part of this event. It is this time of the year when we are all curious what's going to happen to the PSEI. But before that, of course, I'm so glad and thrilled to be here, standing in front of you. Sitting pala. There's no stage. Sitting in front of you and sharing our view of the market from here on July to end of the year. Will it go higher? Will the PSEI go higher? Will it go lower? Or will it just be range trading forever? There's no forever in this market. Everything is dynamic. The PSEI is changing. The environment is changing, not by the years, not by months, not by days, but by the hour, the minute, by the second, and by millisecond, even by millisecond. So we've got to have the most financial education that we need, because we cannot be overly pessimistic. If you're overly pessimistic, given all the headwinds abroad and local, you're going to be paralyzed. You cannot do anything. You won't invest. You're just going to be like freeze. But but on the other hand, if you're overly optimistic, then what happens is that you're going to do revenge buying, and you'll end up doing a lot of revenge cut loss. So it's difficult. So we need to be financially educated so we can navigate this market better. So where am I? I'm in between. I'm not too pessimistic. I'm not too optimistic, just sober and very realistic. So I'm going to share with you my view of the market, where it's going, what are the pitfalls to watch out for. So first slide. So let's see. Let's have first some sort of a history, a background. So the message here is that the PISA is on a 6-month cycle, meaning the recovery of the PISA from the low to the high has always been over a 6-month period. And this is true for the last 2 years, 2020, 2021. What happened in 2020? Recession, lockdown, negative 10% GDP. From start of the year 7815, the PISA dropped 40% to 4,600 in April, March. And then we recovered to a high of 7,400. That happened near the end of the year, 2020. What was the corporate earnings then? Negative 40, negative 80, 57% per quarter. It's all negative. So the following year, we were hopeful. The markets were reopening, the economy is going to grow, and we did grow 5.6% for our GDP. Corporate earnings soared 40%. What happened? PISA rose by another 20%. We had a higher low, 6,100 in May. And from that low, which is higher, of course, than the previous year's 4,600, we rose by 20% to 7,400 again towards year end. So we had another top this year, which was 7,500. And from that occurred February 9. And from there on, we plunge. Who could have predicted Mr. Putin is going to invade Mr. Zelensky, who's going to invade Ukraine? Who could have predicted that? That's why early in the year, we were projecting 7,900, 8,100 end of the year for this year. But Mr. Putin changed all that. The war in Ukraine has roiled markets, weaponized the dollar, weaponized, step up the sanctions, weaponized energy and oil, and we are all in the midst of, now it's in the headlines, it's stagflation, recession risk. So where is the market going? From here on, we think based on the previous movement of the PISA, there is a strong possibility we could be on a 6-month rebound. Next slide, please. So let's look at the other crisis here, the bear markets of 1998, Asian financial crisis, and then 2008 global financial crisis. What happened? We saw a 9-month recovery period after the PISA plunged 61%, very sharp downturn, 1998, 91% upside. And then in 2008, we saw the PISA plunge again, 48% bear market territory, and we PISA recovered 92%. Over a 9-month period. We saw again the PISA plunge because of COVID, and we recovered over a 9-month period 62%. So there is always that recovery period, very resilient, because the economy now is more robust, meaning we're not in lockdown. We're reopening, we're highly inoculated. So the economy is going to roll, as Dr. Abola said, 6 to 7% this year, and corporate earnings, I'll tell you later what is our forecast. Next slide, please. We almost touched bear market territory. So why would you be why would you be investing in equities? Philippines is growing. It's a growing economy. We're not on lockdown. We're reopened. We've inoculated. The best in Asia, GDP of 8.3%. It's a reopening story. It's a growth story. Next slide, please. Corporate earnings still growing 10%, double digit in the first quarter. What about the blue chips? Are they expanding? Capital expenditures 37% projected to be the growth of CapEx this year for the Philippines' best corporation. Next slide, please. What would be the PISA upside drivers? What would be the catalyst? Recently, we all know inflation rose 6.1%, and the market rallied. that's not mainly because of inflation. So many people were surprised. Why 6.1%? And then the market rallied to 6,300 from low of 6,100. And that's really because of the BSP messaging that they're going to fight inflation strongly with a bigger resolve. And that's been the pattern of the market also in the US. Every time the Fed says they're going to fight inflation, bring it down to the target, the market welcomes it and is staging a relief rally. So that is something to be watchful out for. Okay, so for the PSA upside drivers, we should be thankful that we had a peaceful election. You see in Sri Lanka now, it's all political upheaval. In Pakistan, in London, they don't, in UK, they don't have a prime minister. But we had a peaceful election, which means we have democracy working, functioning, and ensuring that the continuation of reforms will be there. And so corporates will be able to plan, invest, and have the confidence that the investment horizon is going to be stable. And then inflation, we're suffering from high inflation, 6.1, but hopefully the BSP policy rate hiking is going to temper the demand spillovers of inflation. We've seen the minimum wage rise 30 pesos, and then transport fares also higher. So the BSP is hiking rates in order to temper the spillover on the demand side. On the supply side, it's BBM saying he's going to be on top of the Department of Agriculture to implement supply side measures. And then we have a BSP that remains to be very pro-growth, not ruling out a triple R cut should the economy slow. Next slide, please. Infrastructure will continue. We have a 5 trillion budget, national government budget this year and even next year. It's going to be PPP-led mostly, as Dr. Abola indicated. And then we will continue with our market-friendly reform, Public Service Act, Retail Trade Liberalization Law, and the revision of the Foreign Investment Act to make it friendlier to foreigners. And don't forget mining, riding the upcycle of the commodity prices. And very good, very investment-friendly regulatory environment. This is the color of mining from Lepanto. Ayan, mining, tourism, and agriculture. Don't forget tourism, we're reopening, vaccinated, and agriculture. We will have a revival in agriculture based on the messaging of the new administration. We're reopened the economy, first quarter growth, highest in Asia. I hope we're able to sustain. Next slide, please. Pillars of growth, as already mentioned by Dr. Abola, BPO continuing to be a productivity boosting tool. This is going to be part of the emerging global, more digital economic growth onwards, globally, locally, and we have a core competitive edge here. OFW remittances continuing to grow 4%, foreign direct investment already at the 12 billion level. 3.4 year-to-date May, 12% growth. Rise of new opportunities because there's going to be Asia-China, US-China rivalry, decoupling, Cold War, and the trade is going to be diverted into friendlier areas, friendlier regions that can deliver on these raw materials, on the intermediate goods. So it's a supply chain reorientation. And it's going to benefit ASEAN. ASEAN is going to be front and center of that trade reorientation. Relative valuation, we are now at 15 times PE. The market has moved lower today, maybe 14.9, 14.5 times PE, on par with the developed markets, a little pricier than the emerging markets, and that's really because we deserve a premium because we're growing. We're sound fundamentally. Regional stimulus. China is not tightening just like the Fed. China is actually stimulating because of the zero COVID policy shock. They're embarking on a 550 billion stimulus. Japan is doing the same, trying to stimulate the economy. It's aging, there's not much consumer spending, and so inflation is low at the expense of the yen, of course. And these are all going to be part of the positive backdrops for the PSA. Next slide, please, to stage the recovery. So this is our view of the year-end scenario, 7,100, EPS growth 10%, 17 times PE. Oh, some are not excited about 7,100. So I will be showing you a portfolio construction na approach. You may consider it, you may spice it with some other strategies, but this is the recovery that we see, 600 to 603 for the PSA now, going to 7,100. The instrument that you should have to be able, of course, it can cut both ways. The instrument that you should have in your portfolio should be the next slide. It's contained. This is the instrument for First Metro ETF. This is the instrument that's going to provide you with instant diversification into the Philippine blue chips, 30 companies of the PSA. So if the view is for the market to recover to 7,100, you have this instrument, you're able to perform on par with the market. So it's just performance on par. You should have some outperformance, and therefore you should have the following. Next slide, please. So for some outperformance, I already mentioned this. Next slide, please. For some outperformance, you ought to build your portfolio of dividend-paying stocks. We've got to have cash flow stocks, the stocks that's going to give us sure money every time. Coincidentally, these stocks happen to be also the best performing in terms of price gains. Look at Semirara, like 20 pesos, it's has gone up to as high as 36 pesos. Meralco, the top gainer. Nickel also very much in demand globally. DMC, SM Prime. So all of these names should be included in your portfolio of dividend stocks to give you that recurring income and your cash flow. Next slide, please. So you should also screen for VLP. VLP is attractive valuation, low leverage, and strong profitability. Valuation is very important. So dividends, I already mentioned earlier, that's for your yield. But for your value is also important. And most of the stocks that you can see on this left side are already showing PEs that are already at half the lowest PE average for the last 22 years. What more do you want? You want it lower? This is already half of the PE during the crisis years. And it is a strong argument for you not to buy them all, but to start accumulating. Start accumulating. Then we want companies, of course, who have very strong balance sheet, huge liquidity, because you know interest rates are rising and financing is very costly now. So go for companies that can withstand the interest rate hikes. And of course, for those that are very profitable, you'll see that the model portfolio here is showing an average of return on equity of 27% and an average leverage of 37% and valuation of half the average of the lowest in the last 22 years. So these are very tough screening criteria. You won't go wrong. Next slide, please. So aside from that screening criterion, you should also make sure that the stocks are riding the wave of some global mega trends and themes like the global reopening, endemic living, companies that are able to take advantage of tax shield like REITs, because they're all bundled up rental portfolio assets that are free, enjoying income tax holidays. And so the owners are able to get dividends that are tax-free. Of course, for individuals, it's 10%. For OFWs, it's 0. So wouldn't you want to be exposed to these companies that are giving you tax, an upside in terms of the tax exemption and also very low valuation now? Some of them are below the IPO price. And the flip side is that you get a higher dividend because you're entering at the very low price. Commodities, we have these names, nickel, Semirara. Play on the foreign exchange gain. These are all exporters. Semirara exporting coal and able to take advantage of the power shortage because it's running on electricity, several electricity plants. Nickel is in the midst of the electric vehicle revolution. It's now engaging into renewable energy. It is an exporter and therefore able to gain also on the FX movement. The banks, you should not forget the banks, because the banks would give you the yield capture. Interest rates are rising, credits, loans are riding the upcycle, 10% loan growth for the entire industry so far. The yields are going to be wider, the spreads on loans. Very strong capitalization, Philippine banking industry, 16%. Metrobank, BDO, BPI, the biggest franchises. We prefer the biggest franchises in the industry because they are the most stable, adequately provided, and if in case the NPLs rise, they are there, very stable, strongly capitalized. We also like energy suppliers because the country is in dire need of more capacity for power. Aboitiz Power, AEV, in the forefront of renewable energy, transitioning from coal and putting up so much battery storage capacity as part of the transition from coal, dirty fuel to clean energy. AEV, Semirara, Meralco, and SGB. Next slide, please. Your dividend play, as I have said, DMC, ARIT, and the reopening stories. These are the companies that are going to make bawi in terms of the P&L because they have been hit so hard by the lockdown. Jollibee, the gaming business, Bloom, GT Cup, Metro, revenge driving. Metro Pacific, expanding into property, expanding into the less regulated industry, healthcare, and recently agriculture, has the highest capex for this year, about 140 billion. Logistics and trade, global reopening, global supply chain reorientation, ICTSI. Next slide, please. So risk to market view, very few. Domestic inflation may be higher than expected. Interest rates may be higher than expected. Escalation of the Russia-Ukraine war and other geopolitical events, and climate-related disasters. So the market will always be there. The question is, will you be there? I will be there. And my next song is, I'll be there. Thank you and good luck to your investments.
Thank you very much, Ms. Ulang, always the entertainer, but with a lot of substance. So there you have it, the much awaited stock recommendations and their drivers. Again, let me kind of like share with you my takeaways. Ride the market and at the same time have some alpha picks. And if I may add, how best to do that than to invest in the country's only ETF, the First Metro Philippine Exchange Traded Fund, which can be accessed through First Metro Securities Brokerage online platform for the secondary trading, or for primary, you can reach out to First Metro Asset Management Inc. That's fami.com.ph. And again, for your alpha picks, again, you have FMSEC online platform. Okay, I'm sure we've got a lot of questions for Christy, but before that, let me just answer the poll that we raised earlier. What is First Metro's investment companies or FMIC's forecast on the PISA by year end? And let's see. Oh, it's a kind of a split. Our forecast is 7,100 and 44% of you got the answer correctly. Although 34% said that we would think that it would probably be 6,800. 18% said 7,500 and about 4% said 7,800. Okay. Well, that's today the market is a little bit down at 6.2. That's a little bit more than 10% to our forecasted number of 7,100. Thank you very much, Christy. Hold on for a second, okay? I also wanted to, okay, well, before that, let me give you some questions that have been phoned in already. Some interesting questions were sent to me earlier. Okay, here we go. Ready? Ready. If the Philippine economy is growing and the outlook for ASEAN region is bullish, including the Philippines, how come the PISA remains low or non-moving with net foreign selling?
Yeah. You know, there's only one reason It's because the dollar is strong. And all the money is going to the US. The Fed is hiking. So bond-wise, the attractive asset is US bonds, haven. It's all risk off. And therefore, the foreign funds are all there in the haven. And the new haven is the dollar. It's not gold. It's not equities. But the silver lining is the fact that we continue to grow. That's the beauty of our economy. Why are we still growing? We are very strong because we have these growth pillars. We have the reforms. Hopefully, we're able to attract foreign direct investment. We have BPO. And the most important thing is really your foreign reserves. Without the foreign reserves, look at Sri Lanka, what happened? The economy will be on a standstill. But it's not, we're far from it. We're so remote from that scenario. We are one of the few countries that have embarked on a very sound history of reforms, fiscal consolidation in the past. We are PPP, gonna be PPP led. So we have this monetary and fiscal space to propel our growth.
Okay.
They are
Thank you.
all
Thank you.
abroad because of the strong dollar. That's the reason. The Fed hiking.
Okay. So in relation to that, or together with that question, what do you think, how important then is hot money or foreign investors to the stock market? How can we minimize the negative effects on the stock market with the outflow of money?
Yeah, that's why we're conducting this financial education forum, because there is now a massive mispricing. The market is pricing us as if we are on lockdown, as if we are on recession, but the economy has reopened already, and there is very little appreciation for the very smooth transition, political transition, continuity of policy reform. The market is filled with jitters, very nervous and distracted, because I cannot blame the market, because we have transitioned from a period of moderation, we've been used to high growth, 6% GDP, and then low interest rates. Last year we were on lockdown. The BSP continued to support the economy, and we did improve in terms of the GDP. But now it's a different story. This supply chain disruption that was caused by COVID is being aggravated by the Ukraine war. Weaponization of the food, weaponization of oil, and so we have this inflation, and we have this war, and we have aging, and we have step-up sanctions, and we may be having an oil embargo very soon. And so the market is confused. How can the market possibly price in all of these moving parts? And so I don't blame the market. It's but natural that the market could be range trading, it's risk off, and the way to mitigate that is really to make people understand that this is a wonderful moment. Some stocks are screaming buy, and this is not the time to run away from the market, because this is the time that can make you. I remember somebody asked me, is a bear market, what does a bear market do? Can it make you rich? A bear market can make you rich. A bull market can make you earn. You can earn from a bull market, it's rising. But a bear market, if you invest in a bear market, it can make you rich, because over a 6-month, 2-year, 3-year period, you wake up and suddenly the stocks have flown higher. So this is a wonderful moment, and you should love crashes, mini crashes, because these are very good and golden opportunity to accumulate. I'm not saying buy it all, you accumulate the good stocks. Be very selective, that's the message. High selectivity is going to pay.
That is so true. Okay, and there's another question here. That's right, in all uncertainties, in fact, to be able to get rich, you want uncertainty so that you can actually take advantage of it. There's another question here. Are there any indicators we should closely monitor? I mean, there are a lot of indicators, but if there's any single indicator that we should monitor, what would that be? That would signal an inflection point. See here. Okay, so they're buying our story that, it's time to accumulate, but is there any indicator that will reflect an inflection point?
The number one killer is inflation. It's the one wreaking havoc in the US, in Europe, here in the Philippines, and it has force banks, central banks of the world to fight inflation. So this is something that is worth watching out for. When inflation is going to peak and how strong will the policy action be? I think these are the two indicators that are going to be closely watched, and once the inflation peaks, then the market will always be forward looking and you can see that the sentiment is going to improve. I don't know what Mr. Putin is going to do in Ukraine, but it is really worth watching also how the supply intervention of the new administration is going to address the inflation or temper the inflation, because most of the inflation now are imported. They are all driven, FX driven, but we have some room for supply chain intervention, agriculture revival, some maybe fiscal, maybe subsidy for fertilizer, strong
Right.
agricultural support, and a keen eye on removing the bottlenecks in the supply chain. So that can help.
Thank you very much, Christy. And one of the comments, let me just share it with you very quickly, is mahilig naman tayo sa discount, di ba? So why not invest now into the market? And as you said, the market's always going to be there. Now, to our panel and to our audience, are we going to be there? Okay, let's move on. Thank you. At this point, I would like to introduce to you our guest speaker, Mr. Oleg Ruban. Oleg is MSCI's Executive Director and Head of Analytics Applied Research for Asia Pacific. As Head of Analytics, Oleg focuses on portfolio management and risk-related research for investment managers. He also leads index solutions research for Australia, New Zealand, and South Asia. Prior to joining MSCI in 2008, Oleg worked as an emerging market economist and a quantitative strategist at Dresner Kleinwort. Oleg began his professional career as a graduate trainee in derivative sales at the Royal Bank of Scotland. Oleg has an undergraduate degree in economics and management from the University of Oxford and MSc degrees from the University of Warwick and Manchester Business School. He also has a PhD in finance from Manchester Business School, where his topic of interest was studies in emerging market debt. Ladies and gentlemen, please join me in welcoming Oleg.
Thank you very much for the wonderful introduction. So as it was just mentioned, my role at MSCI is one where I look after what we call solutions research for our clients for the region of South Asia and Australia and New Zealand specifically. What this means in practice is that once upon a time, I was doing a lot of research, and now I spend a lot of time speaking to our clients about their asset allocation concerns. And most of these clients are large institutional investors. So given this brief, I was asked to come on this webinar and talk about the future of indexed investing, because of course what we are known for at MSCI is indexing. And how might that apply to ASEAN markets, and how might that apply to the Philippines market? So to start with, let me just give you a little bit of context. When we talk about indexed investing, what exactly do we mean? In terms of the AUM that was benchmarked to indexes that are provided by MSCI, our latest estimate at the end of last year was that this was somewhere getting close to 17 trillion in assets under management that are benchmarked to MSCI indexes. Now, about 12 trillion of that is essentially actively managed, and around 5 trillion of that is what we call indexed, or one might call passively managed. And I'll talk about the difference between indexed and passive in just a second. And you can see that overall emerging markets kind of accounts for about 1/10 of that. It's around 1.7 trillion or so. Now, this just gives you kind of a sense of scale of what kind of assets under management follow MSCI indexes and how much of that is active, how much of that is essentially passively managed. But what I wanted to highlight is that more and more, when investors are looking to indexing, they're not just looking to capture the broad market. They're also looking to capture other influences in a systematic, transparent, investable manner. So what does that mean? Well, we can really go back to a lot of the things that Ms. Christina Ulang referred to in her presentation, when she talked about first getting market exposure, but then screening for companies, for example, with a higher dividend yield or attractive valuations, or better quality characteristics. So these are what institutional investors would call factors. So there is a quality factor, which is essentially a portfolio of high quality companies, a dividend yield factor, which is essentially a portfolio of companies that tend to pay more dividends, a value factor, which looks for those segments of the investment universe that are attractively valued. So these, all of these can nowadays be captured via a systematic index, which can then be used as a basis for an investment vehicle. More and more investors are also looking to incorporate other types of considerations into their processes. So our largest institutional investors are talking quite a lot about ESG, environmental, social, and governance characteristics of companies, and how to incorporate that systematically into their portfolio construction, as well as climate. So what happens with respect to climate change? How do they go about decarbonizing their portfolios and taking advantage of green opportunities, as well as, for example, mitigating some of the risks that are associated with climate change? So the key takeaway from this slide is that when you think about passive management and when you think about indexed investing, quite often people think about it as capturing the broad market beta. But actually it has evolved into capturing other types of betas that are in a sense more active in their nature. So investors are more and more making active bets by investing in vehicles that have an indexed implementation to them. And one example of this is, as I mentioned before, ESG and climate. Now, in my discussions with large institutional investors, this has really been dominating as a topic of discussion. So pretty much everybody is asking about ESG and what it means for returns, whether it can have a positive impact on returns, or whether it is at least possible to invest in ESG without sacrificing returns. And more investors are also looking to incorporate climate considerations into their portfolio construction. For example, asset owners who've signed up for net zero are looking to decarbonize their portfolios in line with the commitments that they have made. And what you can see on this slide is that in terms of the growth in assets linked to ESG and climate equity indexes, this has really been kind of exponential, more or less, throughout the last few recent years. Now, I'll return to this topic in a few minutes, but first of all, I wanted to kind of link all of this to what's happening with emerging markets, ASEAN and Philippines more broadly. So I think Dr. Arroyo, the first speaker, as well as Ms. Christina, they have already kind of given a very good overview of Dr. Abola and Christina have given a very good overview of what's been going on with respect to the Philippine economy. And really, when we speak to our clients and when they sort of talk to us about their market views and they talk about emerging markets, there are really kind of two opinions that are emerging. And these can be summarized also in some of the articles that you see in the financial press. So one opinion is that emerging markets are actually in somewhat better shape than people might think. So in a lot of countries, current accounts are shifting into surplus, foreign exchange reserves have grown. And if you look at in US dollar terms, some of the top performing stock markets so far this year have been in emerging economies. So the key takeaway here is that comparing this to, let's say, the taper tantrum, which occurred almost 10 years ago now, fundamentally, a lot of emerging market economies are in stronger shape. So basically don't fear emerging markets. On the other hand, if you think about kind of the current external conditions, soaring global inflation, monetary policy tightening in developed markets, as it was mentioned, military action in Ukraine, this really creates what some people have called a perfect storm. And investors are getting nervous and they have pulled out quite a lot of money from emerging market funds. And if we look at South Asia, again, so the recent article in the Financial Times have talked about, strong GDP growth in the Philippines, which was mentioned here, and how a reopening bounce and base effects are leading to a strong growth environment, which all other things equal, generally could imply a positive environment for the equity markets. So this is kind of the reference to some of the internal and external events and what they might mean for the market environment here in the Philippines. But what are our clients asking us about, and what are some of their key concerns? Well, the first key concern is really the global market term. So the question is, given the current very challenging environment when it comes to markets, where can they turn? The second concern that our clients always bring to us is about inflation. So what does inflation mean for portfolio construction? And we will look at that in a second. Then there is decarbonization. So how does one integrate climate and ESG, environmental, social, and governance considerations in portfolio construction? And finally, deglobalization. So what does this decoupling that we're seeing in the world, the emergence of perhaps new blocks, or just in general, the decoupling in many countries' performance from their kind of traditional anchors, what does it mean for the investment landscape? Now, market turn, well, just to put it in context, if we look at developed markets, which are represented by the MSCI World Index, and if we look at the data from 1975 to this year, we actually saw the steepest mid-year decline in MSCI World since 1975. So the graph that you see here just shows what happened this year in context for some of the steep mid-year declines that have occurred in various other years. And really, this year has been quite exceptional, as you can see in comparison. So what does it mean for investing? Well, the typical kind of mantra that a lot of investors have at this point is trying to keep it defensive and also focusing on real assets. So in the recent blog, my colleagues have researched how asset indexes, real asset indexes, as well as defensive sectors and certain defensive factor indexes performed in comparable market environments. And I won't bore you with the details, but the key finding was that indeed defensive indexes have been robust in historical periods of uncertainty, which gives some idea that or some comfort that they may also be robust in the current period of uncertainty. But one possibility is also to kind of ask the question, well, if we are talking about kind of emerging markets more broadly, or Philippines in particular, are there any defensive characteristics that we can observe in the overall market here? And this was a kind of very kind of a simple comparison if we look at the last 22 years or so, so starting from 2000. And if we look at the market return of MSCI World, and we basically split it into up markets, so the months in which the market return of MSCI World developed markets has been positive in US dollar terms, and down markets, so the months in which the market return for MSCI World has been negative in US dollar terms. What has on average happened in those months to emerging markets Asia, as well as the Philippines IMI? So the Philippines IMI is an MSCI index that captures the large, mid, and small segment of the Philippines market and aims to target 99% of the free float adjusted market capitalization in the Philippines. And what we see here is that while in up markets over this period, the MSCI Philippines IMI index has not performed quite as well as MSCI World or MSCI EM. In down markets, the returns, while negative, have been somewhat less than negative than what you see in developed markets as well as emerging markets Asia. So there is some aspect or some idea to suggest that the Philippines market, the Philippines stock market overall, may have some defensive characteristics to it. So it tends to perform somewhat better than, or has tended historically to perform somewhat better at times when the developed markets as well as emerging markets have negative returns, in months when they have negative returns. Now, the next topic is then inflation. So it's really the highest inflation that we have seen for quite some time. So this chart is already a couple of months old. And here it says the hottest that has been since the 1990s. And there are a few reasons for this. Geopolitical tensions and increased commodity prices have already been mentioned. Deglobalization, which I will talk about a bit more, could mean that there are resource constraints, lack of global competition, and there are supply chain shocks, which also contribute to inflationary pressures. Decarbonization could mean increases in production costs. There is also the monetary policy, of course, is in play here as well. To what extent central banks are ahead of the curve or behind the curve here, and also base effects. So inflation is also higher today because it was very low in the recent past. But in general, what we're seeing in most developed economies is that inflation is running at the levels that are kind of a lot higher than the comfort level of the central banks. And the first question is, what does it mean for portfolio construction? And one aspect of this is, where do you find diversification? So traditionally, over the last 2 decades, bonds have offered strong diversification towards equities. And this was also the environment where interest rates and inflation have been relatively low. So if you look at the middle graph here, and you look at the treasury returns at a time when the market equity returns in the US market have been below 2%, in quite a lot of the months, the treasury return during those times has been positive. So bonds offer diversification benefits during those times. But if you go back to what one would call the great stagflation of the 1970s and early 80s, and you look at what happened to bond returns at times when equity markets have negative returns during that period, and if you also look at the recent history, we see that bonds offer much weaker diversification. So during the 1970s and early 1980s, most of the times when the US equity return was below -2%, the monthly US Treasury return for 10-year treasuries was also negative. And this is again what we observed during the recent inflation rise as well. So the question is, if bonds are not going to provide diversification, where can you potentially find it? And one aspect of it is kind of from an international investor's perspective, as you look across different segments and different countries. And I apologize for the extreme amount of numbers in this slide, but what I really want you to focus on is, again, MSCI Philippines IMI. And the only thing that I would like you to notice here is that overall, the numbers that you're observing in this column, they tend to be somewhat lower in magnitude than the numbers that you're observing in most of the other columns. So basically, if we look at the correlation of the MSCI Philippines IMI index with respect to a lot of the other segments that we're seeing here, so developed markets, emerging markets, Asia ex-Japan, emerging markets in Asia, China, as well as ASEAN, we see that the correlations of the MSCI Philippines IMI in US dollar terms to all these markets are fairly low. So from an international investor's perspective, it may make sense as a diversification play, assuming that these correlations continue to remain low. The next thing that investors talk about to us is really the integration of ESG and climate into portfolio construction. And the idea here is that you want to mitigate risks as well as seize green opportunities, as well as perhaps finance the net zero transition. So you want to build a better portfolio, and by building that portfolio, you might also contribute to building a better world. So how does the Philippines look like when you start thinking about environmental and social governance, as well as the ability to seize green opportunities? So first, let me skip this slide. First, the good news. If we look at our thematic exposures, and again, if we look at the MSCI Philippines IMI index, and we look at efficient energy, actually, in terms of companies that derive a significant proportion of their revenues to things related to efficient energy, MSCI Philippines index has somewhat higher proportion of these, or higher exposure relative to the world index, as well as emerging markets Asia. So that's the good news. The not so good news is if we look at the ESG scores in MSCI Philippines, we see that actually on the kind of the overall market perspective, the overall ESG score, so the overall assessment of performance of companies in the Philippines on average with respect to environmental, social, and governance indicators, is somewhat worse than what we're observing in developed markets, as well as what is observed in emerging markets in Asia overall. Now, there are some variations in this, in that on the social pillar scores, actually companies in the Philippines on average appear to do better. However, they do somewhat worse on the environmental pillar score and the governance pillar score. Again, there's some dispersion in the performance that you see here, but overall this aggregates into a somewhat lower rating on the ESG side. The flip side to this, however, is that if you wanted to ask the question of, how do I benefit from investing in ESG? One of the strategies that has historically in the global markets been able to provide you with alpha with respect to ESG investing is something called ESG momentum. So this is where you try to identify those companies that can improve their ESG scores and then invest in those companies. And typically in countries that have had lower ESG ratings, those ratings did tend to improve through time. So if that does play out in this market, it may or may not, but if that kind of history that we observed elsewhere of when companies start paying more attention to their ESG rating, they will take action to improve some of their behavior that's associated with environmental, social, and governance indicators. That may mean a positive environment for these companies in terms of their returns. And the final topic I want to touch upon is deglobalization. And the idea here is that really, if you look at kind of the typical pairwise correlations or co-movement that you observe in the usual blocks that investors use for asset allocation, whether it's developed markets, emerging markets, or frontier markets, for a number of reasons, some of them very fundamental in nature, such as a stagnating volume of global trade. Some of them are perhaps more temporary in nature, such as geopolitical tensions. These average pairwise correlations have been declining. And indeed, if you look at them kind of more recently, and you look at the dispersion in market performance, you see that up until sort of around 2014, 2015, if you look at the segments of the market on the right-hand side chart, there has been some commonality in terms of the cycles. And then the cycles have tended to really kind of diverge from each other. And if you look at regional correlations across US, EU, Russia, and China, that has really kind of come up quite a bit in the recent months. So what this suggests is a decoupling among the major economic blocks. And this decoupling could also mean a decoupling in market behavior. So what does this essentially mean? This means that potentially going forward, there could be growing dispersion among international markets. And this means that international investors will need to focus more on single country stories rather than look at kind of broader blocks such as emerging markets and developed markets. So they will need to differentiate between the countries within those blocks. The idea here is that they may want to do so on a broad market basis, but also perhaps on a factor basis, targeting certain types of companies within those markets. There may be less reliance on global supply chains, and this is where things like low volatility strategies and innovation-focused investment strategies could be important to manage increased country and regional volatility. And the idea that companies with low leverage, high quality, might also show more resilience with respect to higher geopolitical tensions. And there may also be higher volatility of inflation and higher inflation rates. And again, certain companies, such as those with attractive valuations, have tended to outperform in high inflation periods, as did portfolios that had low volatility or lower risk than the overall market, have tended to outperform in stagflation periods. So again, the implication here is that as there may be kind of more differentiation between the different emerging markets, international investors may look at Philippines more as a distinct entity rather than a part of the broader emerging market bloc. So this may also mean a beneficial impact to the overall Philippine equity market. So I think we are already kind of running close to the time of the webinar. So I will stop the presentation here. And I have to caveat that given my role at MSCI, I cannot actually give any investment views that are MSCI views or kind of forward-looking market views. So that's just a consequence of where we are as a company and where I sit within the structure of that company. However, I will still be happy to answer any questions you have, for instance, on the broad investment trends that we're seeing from the institutional clients. So thank you very much, and I will stop here.
Thank you very much, Oleg. Before we gather everybody together, I think we do have a question for you. Okay. There's a question here for you, Oleg. Do we expect the fund flow trend to be more inward or outward in the short or medium term in Asia or the ASEAN region? And a follow-up to that, which countries in this region would attract most fund flows and which are going to be adversely impacted?
Unfortunately, I will have to divert that question to the other experts here, and I'm sure Ms. Christina, for example, will be able to answer that much better than I can. We at MSCI, we are not able to kind of make predictions on fund flows. We can observe them, but it is not something that we can comment on from a forward-looking perspective.
All right, well taken. In that case, we will invite all of the other panelists to gather together so that we can begin our panel discussion. And while they're opening their videos and their microphones and getting ready for the next segment, we would like to thank our audience. We have reached a high of about 870 participants from all across the country, as well as some participants from international participants from the US, from the UK, and Australia as well. Thank you very much for joining us. Okay, so we have Dr. Abola, Dan, Christy, and Oleg. All right, let's start the ball rolling. There's a question here, and I'll start off with you, Dr. Abola, if you don't mind. Okay. This is from Mr. Solomon Kua, the chairman of AXA. Good afternoon, sir, and thank you for joining us. His question is, how important is it to have new taxes to reduce the fiscal deficit?
It's important if you want to reduce it fast, but at this point in time, I don't think the economy can take new taxes in a big way. Because we are still have to get back to our original growth path. I think there will be a couple of savings here and there. They talk about cutting down the size of the bureaucracy, which means temporary workers there are in danger. And then cutting down, raising taxes on, I think it's practically a given that there will be taxes on online transactions. And not in the sense that there will be new taxes. Actually, it's only a matter of making them withholding agents, and then you'll be able to collect from them part of what they're, what passes through them as a platform. So I don't think that there's such a great pressure at this moment to do anything drastic about our fiscal putting in place new taxes, except to cover a small portion of the deficit, which I said may I not have mentioned that deficit so far up to May that's reported by the Treasury is that it's only a little over 400 billion, which is more than 1.2 billion left if we are to follow the budget proposal of the DBCC. And I think that's enough, more than enough for the rest of the year.
Okay.
They will try even to get lower than that, most likely around 4 to 1.4 trillion, which in itself will be a good step forward already, because that eases the pressure on the upward increase in the debt ratio as well as in the share of interest expense to national government spending.
Dr. Abola, sorry, can you just adjust your microphone, please? I think there are we're getting some comments that you're not as audible. Okay. Either move your microphone closer
Okay, how about now?
Okay, it's fine by me. Dan,
Mhm.
you're nodding your head, so he's coming in
Oh, yeah.
better. All right. As a follow-up question to that, Dr. Ebola, while we have you and we're talking about taxes, there's a question about how the BPO can grow if the tax benefit it used to enjoy will be taken away by the Create law. What are your thoughts on that?
I think that's still under study by
Okay.
the FIRB. We just had a talk with one of the BOI governors, and it is very much an issue on the table. I think they're not going to shoot at our feet in this regard. They'll be a little bit more circumspect because really BPOs have been a very big generator of employment
Mhm.
and dollars and dollar revenues.
Okay, thank you, Doc Apola. We'll move on now to Christy because I think my questions are piling up. Okay, Christy. Let's start off with this. I think this was a good one and it bodes well for all of us. Can you share in brief what are ETFs?
Mhm. Uh, can I also divert?
Don't throw it to me.
So it's a mutual fund that is traded in
Okay.
the market. So
Right.
it's a way of investing passively because you're not doing it actively. No, you're you're investing passively in a sense that you have this instrument which is already mimicking a certain index. And that is the expertise of MSCI. And I think Mr. Ole can better explain. So I better divert. So you construct an index and then you have this mutual fund and then that's tracking. There's also this instrument that's going to be tracking the index. And so you have that, yeah, you have your ETF. We have the First
And
Metro
just
ETF. It's
That's
a
right.
bet on the entire market. You have that instant diversification. You do not need to buy and sell the individual components of the PSA. You just have the entire PSA in your hand
Okay.
by buying the mutual fund. So if the market goes up, your ETF goes up. If the market goes down, your ETF goes down. And it's actually mimicking whatever is happening to the PSA.
That's right.
may,
Thanks,
may I
Christy.
just add a clarification that ETF differs from mutual funds in that mutual funds, the price of the mutual fund, of course, is determined by the mark to market and actual gains and losses of the fund itself. But in the case of ETF, since these are traded in the stock market, the value of the ETF moves in accordance with demand and supply. And of course, the settlement is different, T plus 3 for stock market companies. It will be different from mutual funds in
Okay.
terms of settlement.
Thank you,
Okay.
Dr. Paula. Oleg, did you want to add anything to that as
No, I think it's already been explained
Okay.
perfectly by Ms.
Right.
Christina and Dr. Abola.
Okay, that was quite extensive. We have a lot of other questions with regard to the economy. Dr. Bola, I'm going to throw that back to you. The economy is still domestic consumption driven. Is this more of a
Yes.
benefit for us right now? Or is it time to diversify, to other drivers?
At this point in time, there's not much diversification
That we
for us
can't do?
because the only diversification is to be externally driven, no? And that's not growing because of the ongoing global slowdown. And consumption spending will have to rely on domestic investment and consumption spending. Either way, the concern about inflation eating up into the consumer's budget. Okay, we say let's have an average of 5%. That means that you can purchase in real terms 5% less as a consumer. However, you have to take into consideration the peso depreciation effect on the incomes of OFW, BPOs, and exporters. And that is more than it covers something like I would say about 55, 60 million people in terms of population. So if their incomes increase this year by like on average, I say 8%, it will offset quite a bit to a big extent the slowdown in the overall consumer market. So anyway, short focused on this on OFW families because they will have the wherewithal this year as against the average consumer.
Thank you, Dr. Paula. I have a question that was just flashed into my screen now. It just disappeared. But if I remember it, where did that question go? Here. I don't know if this is something that you'd like to touch upon, maybe based on the experience that you have overseas. Is ESG a significant factor for outside investors when looking at emerging or developing markets?
Generally, yes. More and more so these days, I would say. It depends on the type of the investor to some extent. So I would say that large institutions would likely focus on it a lot more than other types of investors. But if I consider, for example, my conversations with our large institutional clients recently, then a lot of these have been focused on ESG and climate, and a lot of these incorporated also emerging markets and how you might address those considerations in emerging markets. One other thing I would mention is that when we look at the performance of ESG in different segments of the world, one finding that was initially a surprise to us was that actually ESG or better kind of ESG ratings are associated with better outperformance in emerging markets compared to developed markets. So the differentiation in performance according to how ESG is managed is actually more pronounced in the emerging market universe than it is in the developed market universe.
That's quite interesting. Thank you for that. And, we don't have a lot of time, but there's a lot of questions. So very quickly, let me throw the ball to Christy. Christy, the question is, two questions. Should we be investing still? Does it make sense to invest in IPOs? Most of those who's listed recently have performed quite badly. And secondly, I will throw it already to you. What about US dollar global multi-asset funds? What are your thoughts?
What's the second question?
What about US dollar global multi-asset funds? Or dollar denominated funds.
The first question on IPO, is it still okay to invest in IPOs?
Yes.
You have your stub fund trying to help. Of course, we've observed a lot of selling because it's really in the hands of retail, and the tendency is to cash in right on the first day, second day, but there is this stub fund trying to smooth out the volatility. And the important thing really is to look at the companies. If you're interested in the companies, you think it's strong, fundamentally sound, then go for the IPO. So it's selective. It's selective positioning. On the other question was on the dollar multi.
Yes, dollar denominated global funds.
Okay. Of course, dollar is the hot item now, and we cannot prevent people from speculating that emerging market currencies are going to be weaker more because the Fed is hiking, and global central banks are also hiking, but not as fast as the Fed, and therefore the dollar is going to remain strong over the years, and the foreign exchange gain is going to be very attractive. So it's the hot item now, global dollar multi-asset. If it is multi-asset, then better. If it is well diversified, then it's better.
Okay, thank you. Thank you for that. Ladies and gentlemen, it's been a very engaging discussion. There's a lot of questions, but that's pretty much all the time that we have. We all know that the markets are very tentative, but as we had said over and over again, it is in uncertainty that lies opportunity. And as Christy would say, also the market will be here, but will you? Indeed, it isn't for the faint-hearted, but it can be a time to recharge, strengthen our resolve, and make some bets. To end this afternoon's session, may we invite the President of First Metro Investment Corporation, Mr. Patricio Dumlao, to give his closing remarks.
Thank you, Karen. On behalf of the First Metro Group, comprised of First Metro Investment Corporation, First Metro Securities Brokerage Corporation, and First Metro Asset Management Inc., thank you for attending this afternoon's briefing. It was indeed a pleasure, a privilege, and an honor for us to have been given this opportunity to share our views on the economy and the markets. We hope our speakers have been able to shed some light and give you insights to help you navigate during these difficult and volatile times. Thank you also to our guest speaker, Oleg Ruban, Executive Director and Head of Analytics Applied Research for Asia Pacific of MSCI Inc., for taking time to share what they do for the markets and investors in general in terms of index investing. Much appreciated, sir. We join you all in looking forward to a more favorable environment for the economy and the markets, knowing very well that being forewarned is being forearmed. Until our next briefing in January 2023, we leave you for now, asking you the question, do you agree with our cautiously optimistic view that the country is indeed recharging for a new economic age? Will you be brave enough to invest in this kind of market? We're just a call away, should you need us to guide you further. Thank you, and a good afternoon to all.
Thank you, everyone, for joining us today. Once again, my name is Karen Roa. Please stay safe, stay well, and keep on investing. We'll see you again next year.